through investments in government bonds, which account over 40% of the investment portfolio, despite the efforts in recent years of Italian insurers to reduce this figure. And a high allocation to this kind of investment is attractive to insurers because they can provide sufficiently long duration to match their insurance liabilities, and also provide a relatively good return, as I said, compared to other European countries, while incurring no capital charge for spread risk under the Solvency II standard formula. But on the other side, holdings in Italian government debt expose the market to local economic and political instability in the country. Sharp increases in yields can weaken the balance sheets of companies due to the devaluation of assets. In Italy, again, as a result of the COVID-19 pandemic, has had a significant and immediate economic and financial consequences. Balance sheets in the life insurance sector have been affected by the widening of the spread between the Italian and the German 10-year sovereign bonds, which reached over 300 basis points during March 2020, before falling again after the European Central Bank announced the pandemic emergency purchase program. And there has also, during this period, there has also been a widening in corporate credit spreads and a substantial fall in the market value of equity markets, and specifically in this case, Italian listed companies. Due to this reason, we've seen significant deteriorations during these recent months in the Solvency II SCR ratios of some of the major players in this market during the last months. And these are very dependent on spread movements. Also from mid-May, as you can see in the graph, spreads have started to decrease, and this has had a positive effect on the SCR ratios of some of the major players. However, the position of the Italian life insurance segment remains very sensitive to fluctuations in spreads, especially in the very low interest rate environment in which we are now. Just as a brief conclusion in this segment, in our view, there is a buffer in the solvency levels of Italian life insurers to absorb a certain degree of pressure on their balance sheets. However, the segment faces significant headwinds in 2020 due to the impact of the COVID-19 pandemic on the country's economy. Premium volumes are expected to decline, and the operating results of the companies and the solvency levels are likely to be affected by asset devaluations and ongoing financial market volatility. And that is the reason why we've changed our outlook on this segment from stable to negative. Now, in this second part, we are going to speak about the non-life segment. So in this graph, we can see a comparison between the growth of Italian GDP in the blue line and the growth of non-life premiums from 2010. As you can see, both variables are significantly correlated. As you see, the graph shows a progressive recovery